Under probability approach, important calculations that we are doing here, it is the calculation of expected return, rate of return. So that is denoted by RE. Hello dear students, welcome to the session. My name is Kupamdi, faculty in the Department of Commerce, Vidhyaashram First Grade College, the Temple of Excellence, MYSURU. So we are discussing advanced corporate finance for 5th semester BBA. So your risk analysis in capital budgeting. So in the today's sessions, we will discuss the probability approach of measuring a risk in the capital budgeting. See here, under probability approach, important calculations that we are doing here, it is the calculation of expected return. So here, using the probability approach, we are going to calculate the expected return of the project. So usually when two projects are there, which one to select? So at that time, by using the probabilities value, we'll calculate the expected return. So which project has the highest rate of return or the expected return? So that project will be accepted or considered. So we'll see what is probability approach here. So simply the probability means it is the chances of occurring an event or the likelihood of occurrence of any events in the future. So that we call it as a probabilities. So that means there is a chance of what are the chances of happening an event or the future event. So that we call it as a probability. So the probability approach in the capital budgeting, it is one of the important measure to analyze the risk associated in any investment project. So that means, for example, if a manager or if any company is investing in a project, so what is the cash flows or the expected cash flows in each year? For example, in first year, they might expect a cash flow of 50,000. And what is the probability of having or the probability of getting this cash flows? For example, they might assume that 20% there is a chances of receiving these expected or receiving or having these cash flows. So 20% means your chances or probability will become 0.20. Suppose in the second year, they might receive or expect 70,000 of cash flows. So what is the chances or probability of having these cash flows? For example, 50%. There is a 50% probability or the chances are there to receive the cash flow. So that means 0.50 will be the probability or the chances. So what is the expected cash flows by considering the probability? So based on that, the best or the investment project that will be selected. So that we call it as a probability approach in capital budgeting. So here, expected return, here we are going to calculate importantly the expected rate of return. So that is denoted by RE. So your RE formula, it is equal to sigma Px. So your important expected return formula that we use under the probability approach, it is sigma Px, that is P into X. So here P means it is the probability. X means either the cash flows or whatever the given question is there. They might be the cash flow or the rate of return or the rate of interest, ROI. So that will be considered as X, and P here, it is the probability. So we have to multiply P, probability, into X. So that is the given cash flows or the ROI. So we will get the Px. So we'll do the total. So the sigma Px, that will be considered as the RE, that is expected rate of return. So now we'll see the first illustration 1. Calculate expected return on investment from the following information. So that is your RE is equal to sigma Px. So this is the formula that we use to calculate expected return. So here we have given with the ROI, that is rate of interest. So that is 40, 30, 20 and 10. Then we have probability. So the chances of occurrence of an event. So the value they have given for each ROI, it is 0.3, 0.4, 0.2 and 0.1. So this ROI, so that we consider it as X, and probability it is considered as P. So sometimes instead of ROI, if they give the cash flows, that is the expected cash flow, so that will be considered as X, and same probability, that will be considered as P. So this is the question that you have. So now we'll see the solution part. Solution part, here we'll take the first column, it is for the ROI, that is considered as X. Then we have probability, so that is considered as P. So now we take the value, ROI it is 40, 30, 20 and 10. So 40, 30, 20 and 10. Then we take the probability, that is P value. So here it is given in a question, probability 0.3, 0.4, 0.2 and 0.1. So that will take here 0.3, 4, 2 and 1. Then we'll calculate what is P into X. So we'll calculate the P into X, that is 40 into 0.3. So we'll get 12. Then 30 into 0.4, it is 12. Then 20 into 0.2, we have 4. Then we have 10 into 0.1, it is 1. So now we got the Px, that is probability into ROI. So now we'll do the total, that is sigma Px is equal to 12 plus 12 plus 4 plus 1. So the total sigma Px comes to 29. So now we'll do the expected rate of return. Simply your total of Px, so that is the expected rate of return. So that is sigma Px is equal to 29%. So the expected rate of return from this project based on the ROI, so that we are expecting it is 29%. So this is how you will calculate the expected rate of return for the given question. So now we'll same way, we'll see the illustration 2. So here the rate of return of two project X and project Y are given along with their probability. So here you have the ROI or the rate of return for two projects X and Y along with their probability. So the given a choice, which project you would prefer and why. So by considering their expected rate of return, that is RE, we have to calculate or we have to choose which project is best for investment. See the project X, we have rate of return 10, 15, 20 and 25. Then along with that, we have the probability for project X 0.18, 0.12, 0.3 and 0.4. So we have rate of return, then we have the probability for project X. In the same way, we have the project Y details. So the rate of return 10, 21, 22, 24 and 25. Then probability 0.56, 0.14, 0.03, 0.17, then 0.1. So we have the probability. So for this two project, what is the expected return? So that we need to calculate here. See the solution part. So the project X and project Y, we have the ROI, that is rate of interest or the rate of return. First for the project X, we have 10, 15, 20, 25. So what are the rate of return given here? Same, we will take it here. And then the probability also. That is 0.18. These probability we will take here. 0.18, 0.12, 0.3 and 0.4. So now will these two multiplied, so we will get the Px. So probability into ROI. So 10 into 0.18, it is 1.8. Then 15 into 0.12, so that is 1.8. Then 20 into 0.3, that is 6. Then 25 into 0.4, it is 10. So for the project X, we have got the Px. So now we'll do the total of these. So that is the sigma Px. So 1.8 plus 1.8 plus 6 plus 10. So total your sigma Px, it is 19.6. So that means your expected return for project X is 19.6%. So your RE, that is expected rate of return for project X, it is 19.6%. So now in the same way, we'll calculate for project Y also. So first we'll take the ROI or the rate of return for the project Y, that is 10, 21, 22, 24 and 25. So that we'll take here 10, 21, 22, 24 and 25. So the rate of return or the rate of interest for project Y. Then we'll take the probability value. So that is 0.56, 0.14, 0.03, 0.17 and 0.1. So that we'll take here probability. Next step it is we need to find out the PX, that is probability into ROI. So 10 into 0.56, it is 5. 21 into 0.14, it is 2.94. Then 22 into 0.03, it is 0.66. Then 24 into 0.17, it is 4.08. Then 25 into 0.1, it is 2.5. So we have got the PX. So now we'll do the total of all this. So that is sigma PX is equal to 15.78. So that is 5 plus 2.94 plus 0.66 plus 4.08 plus 2.5. So the PX it is 15.678. So the project here, project X, we have 19.6 and expected return for project Y, it is 15.78. So now we'll compare these two. So your X, it is 19.6. Your Y expected return, it is 15.78. So by comparing these two, your RE, so the project X, so that will be considered because it has a higher expected rate of return. So we'll write the recommendation. Project X is preferable with a higher expected rate of return at 19.6%. So this is how, when the two projects are given, we'll calculate the expected rate of return. So that is your RE. So which project has higher rate of return, and that project that will be considered for the investment or for the capital budgeting. So this is the simple approach, that is the probability approach in capital budgeting. So this is the today's sessions, and in the next sessions we are going to calculate the standard deviations and the coefficient of variations. So here in this calculation of standard deviations and coefficient of variations, these are two important concepts from the exam point of view that we are going to discuss in the next session. So this is all about the today's sessions, and we all meet in the next session. Thank you.